Hey, how you doing? This is Adam Post, publisher of more than 1,000 comic books and marketing expert, covering the scam of ESG is in a state of collapse. Investors are taking their money back as woke capitalism has backfired. Let's get into the story. Before we do, please be sure you are subscribed to the channel. Click the bell for notifications. Give me a thumbs up. I really appreciate you guys. Okay, ESG is falling apart everywhere. This is an article from Zero Hedge. ESG is dying its inevitable death. Another article, this is focused on Australia. Corporate boards eye profitability again over woke capitalism. And in the UK, is the ESG boom over? Investors pull out £2 billion, which is actually more than $2 billion, out of woke funds in just 4 months. From Zero Hedge, ESG is dying its inevitable death. ESG refers to the environmental, social, and governance risk theoretically embedded in a business. However, while ESG investing is about taking these risks into account in investment decisions, these are all the things not on a company's balance sheet or earnings statements. Such is the inherent problem. However, as is also the case with the recent surge in liberal policies, woke activism, and demand for social justice, Wall Street is more than willing to sell products to fill a need. Not surprisingly, with plenty of media coverage, ESG investing became an enormous business. Following the financial crisis, ESG funds had roughly a 0% market share of total assets under management. In 2020, ESG-labeled funds in the United States exceeded $16 trillion. It was projected that these funds would exceed $50 trillion by 2025. However, the US, which accounts for 11% of ESG fund assets, saw outflow, so people taking their money out, of $6.2 billion during the final quarter of 2022. But that's not all. What caused the outflows from ESG? The answer is not surprising. Quote, to begin with, ESG funds certainly performed poorly in financial terms. In a recent Journal of Finance paper, University of Chicago researchers analyzed the Morningstar sustainability ratings of more than 20,000 mutual funds representing over $8 trillion of investor savings. Although the highest rated funds in terms of sustainability certainly attracted more capital than the lowest rated funds, none of the high sustainability funds outperformed any of the lowest rated funds. That result might be expected, and it's possible that investors would be happy to sacrifice financial returns in exchange for better ESG performance. Unfortunately, ESG funds don't seem to deliver better ESG performance either, according to the Harvard Business Review. From another article, after peaking at $17.1 trillion in 2020, ESG assets in the United States dropped sharply to just $8.4 trillion in 2022. So it's not going to be $50 trillion in 2025. Not a chance. ESG is dying its inevitable death. Previous discussions of ESG, the author warned that the entire premise was highly flawed. However, performance was always going to be the reason why ESG failed. The reason we know this is that we have seen these investment schemes before. In the late 1990s, Wall Street moved to limit investing in sin stocks, such as gambling, tobacco, etc. Just as it was then, investors initially jumped on board, but when returns failed to outperform the benchmark index, that fad died. The same occurred in 2021 as investors who wanted to feel good about owning disruptive companies. That speculative demand changed quickly when the performance failed. RBC Wealth Management surveyed over 900 US-based clients recently. 49% said that the performance and returns were a higher priority than the ESG impact, up from 42% in 2021. So the trend is going in the right direction. Quote, the story told is you don't have to give up returns in order to do ESG, but everyone assumed that you would get the same exact return profile as a traditional benchmark, which is absolutely not true because traditional benchmarks are not looking at ESG factors. RBC clients also expressed skepticism about the ESG label. 74% of those surveyed said many companies provide misleading information about their ESG initiatives. And this part is hysterical. Quote, investment managers and banks are taking advantage of our collective willingness to help fight climate change because the ESG space is, to put it mildly, a zoo. Epic greenwashing is everywhere. Greenwashing is when they pretend to be ESG, but they're not even ESG. They're just putting ESG on the name of their investment product. Out of 253 funds that switched to an ESG focus in 2020 in the US, 87% of them rebranded by adding words such as sustainable or ESG or green or climate to their names. None changed their stock or bond holdings at that point. Unfortunately, changing your name doesn't change your performance. As RBC noted, performance is all that ultimately matters to investors. However, ESG was a profoundly flawed premise in the first place. One of the most significant problems with ESG is that by applying unmeasurable factors on companies, such inevitability leads to poor decisions. Environment or social issues may sound great as a talking point, but delivering on those goals can be extremely costly. But why are ESG funds doing so badly? Part of the explanation may simply be that an express focus on ESG is redundant. In competitive labor markets and product markets, corporate managers trying to maximize long-term shareholder value should, of their own accord, pay attention to employee, customer, community, and environmental interests. On this basis, setting ESG targets may actually distort decision-making. There's also some evidence that companies publicly embrace ESG as a cover for bad business performance. A recent paper by Ryan Flugum of the University of Northern Iowa reported that when managers underperformed the earnings expectations set by Wall Street analysts watching their company, they often publicly talked about their focus on ESG. But when they exceeded earnings expectations, they made few, if any, public statements related to ESG. Hence, sustainable fund managers who direct their investments to companies publicly embracing ESG principles may be over-investing in financially underperforming companies, from the Harvard Business Review. So when things aren't going right, they just start talking about ESG, and the financial analysts are like, oh, yeah, sustainable. It's going to take some time, so we won't criticize your company. Don't worry about it. In other words, companies will focus on the issues that make them the most productive in a competitive capitalistic environment. However, when companies are forced to make decisions based on meeting some phantom goal or agenda, those choices may not be in the company's best interest. We've seen recent evidence of blowback from these choices in companies like Anheuser-Busch, Target, and others. While these individual companies have faced backlash by offending large portions of their customer base, it is potentially not entirely their fault. BlackRock manages over $10 trillion in assets and has infiltrated itself just about every corner of the financial realm. Given their massive financial presence, they have large stakes in these companies pushing BlackRock's ESG agenda. The question is, why would they do that? Larry Fink, the CEO of BlackRock, is the answer. Not only are investors figuring it out, but so are state pension funds. Quote, lawmakers from red states have called out BlackRock for its toxic woke capitalism push in corporate America. Besides Florida, states like Louisiana, South Carolina, Utah, Arkansas, West Virginia, Missouri, and Texas have withdrawn funds from the asset manager. While consumers have certainly punished companies that overstep boundaries on ESG issues recently, maybe the company we should boycott is BlackRock itself. Absolutely it is. A concerted effort to either pull funds or choosing not to invest in its products may send the most explicit message that the real focus should be on fundamental performance first and foremost. Since investors vote with their dollars, such mainly explains why ESG is dying its inevitable death. From Australia, corporate boards eye profitability over woke capitalism again. In a survey conducted by King & Wood Maleson and reported in the Australian Financial Review, they found that 70% of directors, board of directors members, now consider profitability as their top priority. This represents a notable increase from just 47% in the previous year, when profitability ranked fourth behind concerns about skilled labor, skills shortages, and cyber risks. From the UK, is the ESG boom over? Investors pulled £2 billion out of woke funds in just 4 months. UK investors have pulled nearly £2 billion out of ESG equity funds in the last 4 months in a remarkable reversal of demand for so-called woke stock picking. From the Financial Times, also in the UK, ESG ETFs failed to shine over past 10 years. Scientific Beta's findings contradict the view that sustainable strategies can steer investors towards winners. 10 years of bad results in exchange-traded funds. Exchange-traded funds are SEC-registered investment companies that offer investors a way to put their money together in a fund that invests in stocks, bonds, or other assets. In return, investors receive an interest in the fund. So these would be collected investments by a bunch of investors to invest in a specific fund, and in this case, an ETF fund, which people aren't doing because they're losing money. And even in CNBC, money managers are shifting their attitude to ESG as realism sets in, says S&P's Dan Yergin. In the second quarter of this year, investors have pulled $635 million from U.S. sustainable funds, according to funds research from Morningstar. That racks up a total outflow of $11.4 billion from these sustainable funds in the past year. And as this guy Yergin says, quote, if you're in a money management business, you do need returns. And we've seen that with more North American funds that, yes, we do want to do energy transition, we want to do ESG, but we actually need returns as well. And that has shifted the attitude. There's kind of a more realism. Realism is what we want. Realism is what we need. Merit is what we need. Investors are pulling back, and companies like BlackRock that don't necessarily care, they're happy to lose their investors' money, but the investors are not putting up with it. I had a great comment from somebody on one of my ESG videos saying, hey, Adam, make sure that you point out to people how they can make sure their pensions and their investments are not stuck in ESG funds. The answer on that one is everybody has different relationships with their financial advisors, with their pensions. Some people have pensions, some people don't. If you do have a financial advisor, if you do have an accountant that helps you invest your money, for example, or if it's something that you do at work, talk to them. Say to them, I want to make sure I'm not invested with BlackRock. I want to make sure I'm not invested in any ESG or social justice funds. Talk to them, follow up with them. Make sure they answer you when you ask them, because it is your money and they shouldn't be wasting it on all this. Let me know what you think of all this in the comments below. Always love to see your ideas. Please be sure you are subscribed to the channel. Click the bell for notifications. Give me a thumbs up, and I'll see you again soon with another video. And if I don't see you, I will miss you.